Today, we're diving deep into a specific tax concept that often appears on the CFP exam: below market loans and imputed interest rules. Understanding this topic can be tricky, but it's crucial for both the exam and real world applications. Let's break down what below market loans are. These are loans with interest rates lower than the applicable federal rate, or AFR. The IRS doesn't want people using low interest or zero interest loans to avoid taxes, so they created imputed interest rules. Here's how it works. When someone makes a loan with little or no interest, the IRS will impute or assume a market rate interest was charged. They treat this imputed interest as if it was actually paid by the borrower to the lender. This creates taxable income for the lender and potentially a gift from the lender to the borrower. Now, here's where candidates often make mistakes. There are important exceptions to these rules that you absolutely must remember. First, loans under $10,000 are generally exempt from imputed interest rules. This is known as the de minimis exception. Second, if the borrower has less than $1,000 in net investment income for the year, the rules typically don't apply. Let me give you a practical example. Say a parent loans their child $50,000 at 1% interest when the AFR is 4%. The IRS will impute the additional 3% interest. This means the parent will need to report the imputed interest as taxable income, even though they never received it. The difference between the imputed interest and actual interest paid is considered a gift from parent to child. A common trap question on the exam involves combining multiple concepts. For instance, they might present a scenario where a loan is $9,500 with zero interest, but the borrower has $1,200 in investment income. Many candidates mistakenly focus only on the loan amount being under $10,000 and conclude no imputed interest applies. However, because the borrower's investment income exceeds $1,000, the imputed interest rules would actually apply. When studying this topic, remember these key points. The AFR is determined monthly by the IRS and varies by loan term. Imputed interest creates phantom income for the lender. The exceptions are based on both loan amount and the borrower's investment income. The rules apply to both family loans and employer-employee loans. Here's a pro tip for the exam. When you see a question about below-market loans, immediately check two things. First, is the loan amount under $10,000? Second, what's the borrower's investment income? This systematic approach will help you avoid common pitfalls. Also, don't forget that timing matters. These rules apply to term loans differently than demand loans. For term loans, you look at the AFR when the loan is made. For demand loans, which can be called at any time, you need to consider the AFR each year. Remember, the IRS created these rules to prevent tax avoidance through artificially low interest rates. Understanding both the general rule and its exceptions is crucial for success on the CFP exam. When you encounter these questions, take your time and methodically work through the exceptions before jumping to conclusions. Your analysis should always start with the loan amount and the borrower's investment income.